All right, let's say we're getting rid of an asset that is not fully depreciated, meaning it still has value, but we're done using it, and maybe we bought a new piece of equipment, we can't sell it, so we're just going to get rid of it. All right, now things don't always happen nicely all on December 31st. Oftentimes you have things happening during the year. So in this case, what the scenario is we have equipment that's worth $6,000. We've been depreciating it every year for 10%, right? So it's $600 every year. And right now, there's a $4,750 balance in accumulated depreciation. So let's get those numbers in there first. The equipment has a value of $6,000. And so far, right now, the years of accumulated depreciation are $4,750. That's where we are right now. So what they're saying in this slide here is we got rid of the equipment on March 24th, but the last time we did the adjusting journal entry for depreciation, it was done presumably on December 31st. So here we are, it's March 24th. We have to reuse this equipment for January, February, and March. So it is a valid depreciation expense that needs to go on our income statement of January, February, and March. We need to record the 3 months that we did use it for. So to get back to this, what we're looking at is it was $600 a year for depreciation, or no, yes, $600 a year for depreciation. So a full year would be $600, but we're not talking about a full year. We're talking about $600 times 3 months out of 12 years. So what we're really looking at is we're looking at $150 of depreciation. So the very first thing if you get rid of something mid-year to do is to catch up on the depreciation so that you have recorded January, February, March's depreciation. Here we go. So what we're going to do is our journal entry is going to be a debit to depreciation expense and a credit to accumulated depreciation for January, February, and March's use of that asset. Alright, that is going to be the first thing we do, is to catch up on depreciation. Now we're good. We've depreciated all the way through March, and we've got $6,000 worth of equipment, and we've got $4,900 worth of depreciation at this point. Okay? I'll put the number in there. Okay, so now we're going to get rid of this asset, but as you can see, we did not fully depreciate it. So really, when we toss it in that dumpster, we're losing $1,100 on this transaction. All right, your steps are always the same for the most part when we're getting rid of an asset, right? When we're taking it off the books. There are a couple of steps. Actually, I'll start up here. The first thing we do is we take the equipment off the books. We've got to zero it out. So we've got a credit to equipment of $6,000. Lost my line. You've got a credit to equipment of $6,000. My equipment is now zero. Also, I'm going to have to debit my accumulated depreciation for $4,900. So that now, I'll draw the line in a second, now my accumulated depreciation is zero. So the steps are always the same. Take the equipment off the books, take the accumulated depreciation off the books. Make those your first steps when you're doing this. So here we go. Let's fill this out. You've got a debit to accumulated depreciation of $4,900. You've got a credit to equipment of $6,000. But as you can see, as I said before, these amounts don't balance now. The piece that we're missing is going to be a loss, because we're basically throwing equipment away that's got a value of $1,100 to us, and that is, when we throw it away, that is going to be a loss to us. So the full way of writing it is loss on disposal of equipment, but I don't have enough room to write all that, so I'm going to be happy with loss. Maybe I'll just write loss disposal. Still a little bit tight on room. All right, but $1,100, and that's going to make your equation balance, your journal entry balance. Okay, so this is the journal entry to take the equipment off the books and to record the loss. Okay, as you can see, it's the same here in your slides. Okay, moving on. Let's say we're selling our asset now. All right, equipment costing $10,000 is depreciated annual straight line rate of 10%. It would have been a lot easier if they kept us using the same numbers. The equipment is sold for cash on October 12th. Now, I think this problem would be easier if this was October 1st, but there we go. We'll make it October 1st. Easier to understand. Accumulated depreciation last adjusted December 31st has a balance of $7,000 and needs to be updated. Okay, So here we go. We've got $10,000 and each year it's 10%. So let me update all of the numbers that are in here. Alright, so here we are. We've got equipment worth $10,000. They told us we had depreciated so far $7,000 of it, but we haven't done any depreciation entries since the prior December 31st. And here it is October 1st. Alright, so each year, $10,000 at 10% is $1,000 worth of depreciation, but we're not doing an entire year's worth of depreciation. Right, 10,000 times 10%. Oops, a little bit tight here. Let's see. Room. Let's try that again. $10,000 times 10% is $1,000 a year worth of depreciation, right? So we've got $1,000 a year, but we're only looking at January, February, March, April, May, June, July, August, and September. So we're really only looking at 9 months worth of depreciation where we have to catch up. So what we're looking at is $1,000 times 9/12 is $750. That's how much depreciation we have to include so far. So our first journal entry is going to be a debit to depreciation expense and a credit to accumulated depreciation of $750. So here, to be complete and be thorough, I will put that entry in here. Accumulated depreciation of $750. So that's where we are right now. So the net book value of this asset is $10,000 minus $77.50, which is $22.50. Let's see, $20,000 minus $77.50. Yes, $22.50. So if you were to ask me right now, the value of this asset is worth $2,250, right? Actually, right now it's worth, here we go, $22.50. Okay, so now it's kind of easy to determine from this point the next couple of steps. What you have to decide for yourself is if you're going to sell this equipment. If you sell it for cash of $2,250, then you have no gain or loss. If you sell it for more than $22.50, you're going to have a gain, and if you sell it for less than $22.50, you're going to have a loss. All right, so we're going to work through this with each of those scenarios. So the first scenario is we are going to sell it for $22.50. We're going to sell it with, I keep pressing the wrong button, sorry guys. We're going to sell it for no gain or loss. So when we sell it for no gain or loss, we're going to do exactly the same things we've been doing so far. I'm not going to write into the T accounts themselves, I'm just going to do the journal entries down here. We're going to debit accumulated depreciation so that this way we zero out that account for $77.50. Oops. And we are going to credit my equipment for $10,000. And the piece that's missing here is actually the cash I received. We got cash of $22.50 in this scenario. There's no gain or loss. We've taken the equipment off the books, taken the related accumulated depreciation off the books, and we've recorded the cash we received. That is our journal entry for that one. Okay, so now alright, so there's the same journal entry there. Now let's say we sell it for $1,000. Well, if it's worth $22.50 to us, we know right off the bat if we're selling it for $1,000, then we've got a loss, right? So we do the same piece here, we do our catch up and all that kind of stuff. Now it's just the last piece is the journal entry. Well, we're going to take the same steps again. We're going to record, I'm going to start with cash this time. We're going to record the cash of $1,000. I usually like to start with cash. We're going to debit the cash. We're going to debit accumulated depreciation because we're taking it off the books of the $77.50. We're going to credit equipment for $10,000. Okay, well we know we have a loss because it's worth $22.50 to us, but we're selling it for $1,000. So with that, a loss is very similar to an expense, and that is always a debit. It reduces your income on your income statement. So your loss is going to be for the $1,000 minus the $22.50, or $1,250. That will be what it takes to make the equation balance. Okay, last one. Let's look at what happens if we have a gain. If we have a gain, we're selling it for $2,800. Again, just say to yourself, all right, what's the book value? Book value is $22.50. We're selling it for $2,800, so we actually come out ahead on this thing. We have a gain. So we're going to take the same steps, record the cash, just because cash is cash, of $2,800. And we're going to take the accumulated depreciation off the books. We're going to zero that out, $77.50. We are going to take the equipment off the books. Oops, tab over. We're going to credit the equipment for $10,000. The other piece to make this balance now is going to be a gain on the sale or the disposal of the equipment of, let's say it was $2,250 minus $2,800, $550. Oops. And that should make this equation balance, okay? Gain is very similar to revenues in the sense of that it raises your net income number. And that's it for that part.